And we take a look at the big picture with Adam Coons, Co-Chief Investment Officer at Winthrop Capital Management. Thank you for being here. So some of your thoughts, big picture here.
Yeah, I mean, it kind of feels like the market's getting a little bit exhausted with this narrative over the tariffs. And so obviously we had a big week with the Fed. That turned out to kind of be a nothing burger, which is what we expected. No rate cuts, and really just this narrative around wait and see. And so I think that's going to be how markets are going to be reacting for the next several months. As you know, the Fed really isn't going to take any action. We'll see some things here and there from Trump on the tariff front, but probably going to be a lot of what we saw, you know, coming out of Europe and the supposed deal that really seemed like there weren't a lot of changes or really concessions. That 10% tariff is still there. So I think that's going to be the kind of the market, at least through the rest of the summer.
I think a lot of folks are concerned at this point about what goes on with China talks this weekend. And, you know, if they really get started, Scott Bessent's involved. I mean, that certainly brings a vote of confidence from our country to show how serious we are. At the same time, it's unpredictable what could happen in this conversation.
Unpredictable.
It's a lot of history, right? I mean,
that's a great word.
You know what I mean? It's just there's so much history in this. So, you know, this could be a wild card.
It could be. I mean, there's obviously a lot at stake as well. And so I think, you know, a lot of people are talking about how the ports are either empty here or overflowing in China. And I think that really, you know, states the case that, you know, we're looking at, okay, what do tariffs mean for the U.S.? But I think we need to look at the other side of this and what do tariffs mean for China, and the fact that if we're not really seeing these imports come in, they have a lot more to lose right now.
Right.
And so, you know, that could drive the narrative from Bessent and how these negotiations go, because what we've kind of felt out of the Trump administration is, you know, having that heavy hand because they feel like they have the upper hand. And so one worry, as you're saying, is, you know, going into these talks, if they come in with that type of tone, that may not work well with China this time around.
Tell me about what you're looking for in the world of bonds. That's something on your mind.
It is, yeah. I mean, coming into this year, we definitely were taking a defensive tilt. Bonds, fixed income were a way to do that. And for us, you know, when we're investing, we really look for places where what we say asymmetrical risk to reward, meaning, you know, there were more rewards for the risk you were taking than that risk, right? So if the way I look at it for bonds is that there's three scenarios. Either interest rates stay exactly where they are, and I'm happy to collect, you know, above 5% type yields in fixed income if nothing changes in interest rates. If you did see interest rates come down, which obviously we know that Trump is pushing for, that would lead to a price appreciation of my bonds. The only scenario that doesn't work is if we see rates go dramatically higher. And we think that's a really low likelihood. So that's why we really like the fixed income trade right now.
Right. I mean, it is interesting to see the move we've had in the 10-year bond yield just in the last, you know, I want to say hours, but I'll say a couple of days, right? 4.37%. So it has been ticking higher.
It has been.
Yeah.
It is extremely volatile right now. If you look at the MOVE index, it's kind of the similar index as the VIX. So it's the volatility on bonds. It is skyrocketed.
Right.
And so, yes, because we got below 4% there for a moment, you know, kind of at the beginning of the year. And then as these tariffs started to roll out, you saw interest rates go much higher. So you're right. We have seen it tick higher. But if you look at it, you know, from where we were probably 6 months ago, they're right about where they were.
Right. No, I mean, and if you look back historically, you know, the volatility we've had recently, you can sort of say we're okay.
Sure.
Right.
Yeah.
We're off the lows.
Yeah.
I mean, we're only down a bit. We look back to last year. I mean, you had 20% consecutive years.
Right.
We had a little to give back, probably. I mean, some people don't want to hear that, but you know, there's greater purpose happening here, right? Ultimately, trying to get some deals in the works, trying to pay down the deficit. I mean, there's a big worry about our country's debt.
Sure.
And so that's something front and center. What would you say goes into a portfolio? If people say, what do I do? What do I do with my money? How do I handle this? You know, short term or long term? What do you advise folks?
Well, obviously, and you'll hear anyone say this, it depends on the client and the risk tolerance and all those things. But let's say you have that determined. You really need, you're kind of weighing that risk and almost that emotional reaction. And what I tell people is if you're having a visceral emotional reaction to markets down 5 or 10%, you probably have too much risk in your portfolio. So that's a starting point. For us, we like to have somewhat of a balanced approach where we're using both equities and fixed income. And we'll just tilt the factor exposure. When we want to take on more risk in fixed income, we'll go to high yield.
Right.
Coming into this year, we moved far back in our corporate exposure, and we're way overweight treasuries. And then the equity side is the same thing. You're in growth stocks when things are good. When things start to get overextended, like you said, 2 years in a row of 20%,
right.
We kind of felt the same way. We're overextended. We don't want to time the market, but let's just dial back the risk. And that means moving from your growth stocks into more value-oriented or dividend-type paying stocks. So that way you're still exposed to equities and you would still capture the upside, but it does minimize the downside if we get a situation like this.
And so many folks say the tariffs will equal inflation. You do not think so. What do you think?
Well, look, tariffs, if they're done, at a large scale, will create demand destruction. I don't know how you can get around that, because if prices are higher, people don't just suddenly have more money in their wallet to pay for this. So they have to start making decisions and choices. And so if your iPhone suddenly costs $3,000 because it's made here, you might switch to an Android, or maybe if the iPhone's very important to you, you're gonna give up something else. But something has to give, and ultimately that is deflationary, and that would be a downturn in the U.S. economy potentially. Not something that we want to get people overly excited about, and I think that's kind of what we're trying to weigh out right now from an administration is how much pressure can we put on other countries and tariffs while still maintaining the support of the U.S. consumer.
Right. Are you still interested in the tech trade, cybersecurity? These are areas that, granted, some has fallen off, coming back.
Sure. Yeah, I mean, look, the things that have been working will still probably continue to work if it is a sound business model. I think where you want to be careful are some of these tech companies or AI companies that are a one-trick pony, but where we like tech right now is in those more established names. So Google, Alphabet, or Microsoft, where they have a really robust business model and AI can make it a little bit better. Some of the specific things we like in AI are cybersecurity. That's as granular as we're getting right now in AI and in tech. We really still like the large cap tech trade right now.
Yeah, Adam Coons, great to see you at Winthrop Capital Management.
Thank you.
Thanks for being here
thanks for
today.
having me.
Appreciate it. What a wild ride we've had. So you expect some more volatility, but maybe not as much inflation. And we'll get those prints next week, folks, right? CPI and PPI and then retail sales and Walmart and so much more.